Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. Okay, in this video, we'll be going over A-Level Accounting 2023 October-November, Paper 2-1, question number 2. This is a Paper 2 which consists of 4 questions. 2 of them will be of 30 marks and 2 of them will be of 15 marks. And the total time limit given for this paper is 1 hour and 45 minutes. Since question number 2 is of 15 marks, ideally you should be spending about 17 and a half minutes in order to solve this question. And in this video as well, we'll be attempting to solve this question under 17 and a half minutes. So without any further delay, let's get started. Q Limited has been in business for a number of years. One of the directors is unsure of the difference between a capital reserve and a revenue reserve. So we now need to explain one difference between a capital reserve and a revenue reserve. So the most basic difference is that capital reserve will be created as a result of non-trading activities such as sale of non-current asset or revaluation of asset and those things, whereas revenue reserves will be created by transfer from profits that we have figured out within the statement of profit or loss. Let's write it down. Capital reserves are created as a result of non-trading activities whereas revenue reserves are created by transfer from profits. And remember that the dividends can only be paid out of the profits, right? This is why we can only utilize our revenue reserves in order to distribute the dividends to our shareholders, because revenue reserves are created by those profits, whereas we cannot be utilizing our capital reserves because they are not created as part of the profits, which is why we cannot be utilizing our capital reserves in order to distribute the dividend to our shareholders. That's all for the first part. Now we have additional information. The directors of Q Limited provided the following information for the year ended 30 June 2023. This is our ending date or the closing date. We have been given the balance at 1st July 2022. So all of these will be our opening balances. We have our share capital of 30,000 at the rate of 0.50. This is the nominal rate of our shares. We then have the share premium, revaluation reserve, retained earnings, total equity, which is just the sum of these 4 items, and then the 8% debenture, which will have to be repaid in the year 2024. This is of 40,000. Then at 1st July 2022, land, original cost of 80,000, had a valuation of 86,000. No other non-current assets had been revalued. We can see that the value has gone up now, which is why this is a revaluation upwards, which will be of 86,000 minus 80,000, which is of 6,000. That is why we have included the 6,000 revaluation upwards as part of our revaluation reserve. Now, the following transactions took place during the year ended 30 June 2023. At the date of 1st August 2022, we made a bonus issue of 1 ordinary share for every 6 shares held. So this just means that for every 6 ordinary shares that we have, we provided 1 new bonus share. Now, in order to calculate the number of bonus shares, we first require the number of ordinary shares that we have. And in order to calculate this, we just need to divide the value of our ordinary shares at the opening date, which is 30,000, by the nominal rate, which is 0.5. And this will give the number of ordinary shares to be 60,000. So now we need to calculate the corresponding bonus shares for the 60,000 ordinary shares. So we will be utilizing our unitary method. For 60,000 ordinary shares, we need to provide 1 by 6 times 60,000 bonus shares. So that will be of 10,000. So we'll provide 10,000 bonus shares. And this 10,000 bonus shares will be provided at the rate of our nominal value, which is 0.50, because remember that bonus shares will be funded by our reserves itself. We cannot be issuing the bonus shares at a premium. So the value of bonus shares that goes towards our share capital is just going to be the number of bonus shares, that's 10,000. Then we need to multiply it by the nominal rate of 0.5. And this gives the value of our bonus issue to go towards the share capital column to be of 5,000. Then we need to fund this 5,000 utilizing our reserves. So the first reserve that we will utilize will be share premium, which is only of 4,500. But remember, we need to fund 5,000. So out of this 5,000, 4,500 will be funded by our share premium. The remaining 500 should be funded by our retained earnings. So that will be for retained earnings. Alright, that's all for the first transaction. Then at the date of 1st October 2022, we paid a final dividend of 0.04 per share on all shares in issue at that date. So at the date of 1st October 2022, we have the initial number of ordinary shares. Then we also made a bonus issue. So the total number of ordinary shares at the date of dividend payment is going to be the initial number of 60,000. Then we also issued 10,000 bonus shares. So we need to add this as well. So the total number of ordinary shares we have will be 70,000. So the dividend will have to be paid on 70,000 shares. So in order to calculate the total dividend, we can just multiply the total number of ordinary shares, that's 70,000, by the rate of dividend, which is 0.04. This results in the value of 2,800. And this is the final dividend. That's all for the second transaction. Then at the date of 1st January 2023, we made a rights issue of 2 ordinary shares for every 7 shares held at a price of 0.65 per share. So we are issuing this at a premium rate because our normal rate is only 0.50. Then the issue is fully subscribed. Okay, the criteria is that for every 7 ordinary shares, we're providing 2 rights shares. And remember, the total number of ordinary shares we have currently is 70,000. So again, we'll be utilizing the unitary method. For 70,000 ordinary shares, we have to provide 2 by 7 times 70,000 right shares. So that will give us a total of 20,000 right shares. Okay, so the value that will go towards our share capital will be at the nominal rate. So in order to calculate this, we can just multiply the number of right shares of 20,000 by the nominal rate of 0.50, which gives the value of 10,000. Then since we are issuing this at a premium, so out of 0.65, 0.5 is our nominal rate. The remaining value is 0.65 minus 0.50, which is of 0.15. So this is the premium value which will go towards the share premium. So the value that goes towards the share premium due to this rights issue is just going to be the number of right shares issued, which is again 20,000, multiplied by the premium rate of 0.15. And this gives the value of 3,000. That's all for the third transaction. Then, at the date of 1st April 2023, we paid an interim dividend of 0.02 per share on all shares in issue at that date. Okay, so the first thing that we need to do is calculate the number of ordinary shares at the date of our dividend payment. So we had previously calculated the 70,000 ordinary shares after including our bonus issue. Now we again have to include the rights issue. So that's of 20,000, which gives the total number of ordinary shares to be 90,000. And we need to pay the dividend on these 90,000 shares. So our interim dividend is just going to be the number of ordinary shares, that's 90,000, multiplied by the rate of dividend payment, which is 0.02. This gives the value of 1,800. That's the interim dividend paid. That's all for the fourth transaction. Then at the date of 30 June 2023, land was revalued at 75,000. So previously we valued it at 86,000. Now it has a value of 75,000, which means that there is a revaluation downwards. And the revaluation downwards is of 86,000 minus 75,000, which results in 11,000. And since this is a revaluation downwards, we need to subtract the 11,000 from our revaluation reserve. But in this case, remember that we only have 6,000 within the revaluation reserve and we cannot have a negative reserve. So we only subtract 6,000 from our revaluation reserve and the remaining 5,000 should be subtracted from our retained earnings. So for this 11,000 within our revaluation reserve, we only subtract 6,000. Then from our retained earnings, we subtract the remaining 5,000. That's all for the fifth transaction. Then the draft profit for the year ended 30 June 2023 was 43,600. This is the profit which we always need to add towards retained earnings. Okay. Now we need to prepare the statement of changes in equity in the year ended 30 June 2023. We were given the balances at the opening date, so we can just copy down those amounts. That will be 30,000, 4,500, 6,000 and 50,240 and a total of 90,740. Let's write it down. So for share capital, it was 30,000. For share premium, it was 4,500. For revaluation reserve, it was 6,000. For retained earnings, it was 50,240 and the total was of 90,740. Okay, now we need to start with our transactions. So the first transaction was of the bonus issue. Let's write it down. That's the bonus issue. And we have already calculated everything, so we just need to include those amounts now. For this bonus issue, we have to include 5,000 within our share capital. We need to subtract 4,500 from share premium and 500 from our retained earnings. Let's do that. So 5,000 will be added to the share capital. Only 4,500 will be subtracted from share premium since we cannot have a negative reserve. Then the remaining 500 should be subtracted from the retained earnings. And always remember that the total of bonus issue will be 0. That's all for the first transaction. The second transaction was a final dividend paid, and the amount was of 2,800, which we always need to subtract from our revenue reserve, which is the retained earnings. Let's write it down. So that's the final dividend. We need to pay it out of the retained earnings, so we will be subtracting 2,800, and no other columns will be affected. That's all for the second transaction. Then we have a rights issue. Again, we have calculated everything. So for rights issue, remember that within our share capital, we need to include 10,000. And within the share premium, we need to include 3,000. Let's write it down. So that will be 10,000 in share capital, 3,000 in share premium. So the total is just going to be 13,000. That's all for the third transaction. Then the fourth one is of the interim dividend. And we've already calculated the dividend amount to be 1,800. And always remember that dividends will have to be subtracted from our retained earnings column. Let's write it down. So that will be interim dividend of 1,800, and the total is going to be the same. That's all for the fourth transaction. Then the fifth one was our revaluation downwards, and we've already allocated the amounts as well. Out of the total 11,000, 6,000 should be subtracted from our revaluation reserve, and the remaining 5,000 will be subtracted from our retained earnings. Let's write it down. So this is revaluation. 6,000 will be subtracted from our revaluation reserve because we cannot have a negative balance. That is why the remaining 5,000 will be subtracted from the retained earnings. So the total will be 11,000 negative. Then we were also given information regarding profit for the year, which was of 43,600, and we should always add this to the retained earnings column. Let's write it down. So that will be profit for the year of 43,600. Okay, we've included everything. So now we can calculate our closing date balances, and that will be at the date of 30 June 2023. So at 30 June 2023, the value of our share capital will be the sum of these three amounts. So that's 30,000 plus 5,000 plus 10,000, which results in 45,000. Then for our share premium, that will be 4,500 minus 4,500 plus 3,000, which gives the value of 3,000. For our revaluation reserve, that's just going to be 6,000 minus 6,000, so that will be 0. Then for our retained earnings, we have 50,240 minus 500 minus 2,800 minus 1,800 minus 5,000 plus 43,600, which results in 83,740. Now for our total column, that is going to be 90,740 minus 2,800 plus 13,000 minus 1,800 minus 11,000 plus 43,600, which results in 131,740. That's all for our second part. Let's move towards the next one. So we are given additional information. The directors of Q Limited have plans to expand the business at a total cost of 54,000 and are considering two options to raise finance. The first one is to make a rights issue of 4 ordinary shares for every 5 shares held at a price of 0.75 per share. Okay. Then option 2 is to issue a 10% debenture, which will have to be repaid within the year 2026 and 2027 of the same value of 54,000. So we are already given the value for option 2, but we are yet to figure out the value for option 1. Let's calculate that. So for option 1, our criteria is that for every 5 shares held, we are providing 4 rights issue. So for every 5 ordinary shares, we are providing 4 rights shares. And remember, the total number of ordinary shares was 90,000. Again, we will be utilizing our unitary method. So for 90,000 ordinary shares, we need to provide 4 by 5 times 90,000 rights shares, which will be 72,000 rights shares. And the value of rights issue is just going to be the number of rights shares, that's 72,000, multiplied by the rate at which it is being issued, which in this case is 0.75. And this gives the value of 54,000 as well. Okay, so the value raised by option 1 as well as option 2 is the same. Now for the third part, we need to advise the directors which option, if either, they should choose. We need to justify our decision. Okay, so in this case, we just have to write down the differences between the rights issue and the debenture. So the very first difference is that rights issue is a permanent source of capital, whereas debenture will have to be repaid. Let's write it down. So rights issue is a permanent source of capital, whereas debenture will have to be repaid. Then the next difference is that dividend payment is discretionary, because if there's a loss in a particular year, then the company can choose not to pay any dividends, but that cannot be said for debenture, because interest must be paid regardless of whether the company is making a profit or a loss. Let's write it down. Dividend payment is discretionary, whereas interest on debenture will have to be paid regardless of profits or losses. Okay, now based on these factors, you need to make a decision. And in cases where you need to compare rights issue to debenture, personally, I would always favor the rights issue, because for rights issue, we do not have to make any fixed interest payments, which will not reduce the profits. Let's write it down. So the decision is that the directors should choose option 1, as there will be no fixed interest payments which could reduce our profit. Alright, that is all for the second question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.